For decades, modern portfolio theory has directed investors to build static portfolios heavily concentrated in moderate risk assets. The goal has been to find safety and steady returns right in the middle of the risk spectrum. This bell curve illustrates the bedrock assumption of that traditional approach. The model assumes financial markets behave with predictable regularity, clustering the vast majority of potential returns cleanly and safely in the center. But real-world financial markets routinely break this assumption. Extreme economic shocks and severe market crashes occur with a frequency that normal models label statistically impossible. The tails are actually fat with chaotic outliers. When these unaccounted-for crises materialize, that clustered middle collapses. Assets assumed to be safe lose their value simultaneously, exposing the investor to catastrophic drawdowns. That same middle ground also acts as an anchor during economic expansions. By stripping out high volatility, high growth equities to maintain a low risk profile, the portfolio suppresses its own compounding power during strong bull markets. Concentrating capital in the moderate middle guarantees unexceptional growth during good economic times, while offering no mathematical protection when the system actually breaks. The Power Barbell Architecture abandons the middle entirely. It divides capital strictly between the opposite ends of the risk spectrum. The foundation allocates 70 to 90% of your capital into ultra-safe, highly liquid, short-duration debt and Treasury bills. Economist Robert Merton formalized the mathematical necessity for this heavy anchor through the intertemporal capital asset pricing model. Merton's model defines risk as the intertemporal hazard of not having capital available at the exact value and time it is needed to meet future consumption liabilities. Under this lens, short-term price fluctuations are secondary to the danger of a terminal capital shortfall. Allocating the vast majority of a portfolio into an unyielding cash foundation mathematically eliminates the risk of terminal ruin. No matter how severely the broader equity markets collapse, the capital required to survive remains intact. With survival guaranteed by the anchor, the remaining 10 to 30% of the capital is deployed into a high-entropy basket of hyper-volatile equities. Traditional investing buys safe, stable companies expecting reliable returns. The barbell strategy actively buys the most chaotic, unstable stocks on the market in order to capture outsized exponential gains. If you buy one or two of these highly volatile stocks in isolation, your probability of losing your entire investment is high. They experience failure rates similar to early-stage venture capital. You neutralize this high failure rate through extreme cross-sectional diversification. You group together volatile assets that react to the economy in completely opposite ways. Consider an aggressive semiconductor manufacturer. Its stock price swings wildly in response to consumer electronics demand and global supply chain bottlenecks. You pair that technology stock with an energy producer. Its revenue relies on physical commodity cycles that often run counter to a tech boom. Because these assets are negatively correlated, their extreme price shocks collide. When the tech stock crashes, the oil stock spikes. The individual chaotic swings actively cancel each other out. The idiosyncratic risk of the individual companies is destroyed, but their structurally higher expected returns remain. The safest, most profitable compounding engine is built by mathematically disarming the market's most dangerous assets. Maintaining a broad basket of 30 to 80 volatile stocks activates a secondary source of growth, the rebalancing premium. High volatility assets naturally suffer from volatility drag, a mathematical penalty where high variance eats into long-term compounding returns. By periodically rebalancing between negatively correlated assets, you slash that portfolio-level variance, transforming that lost energy into an annualized compounding bonus of 2 to 4%. When severe market panic eventually strikes, an investor holding a moderate static portfolio has no choice but to freeze and watch their capital bleed out. The barbell investor treats that same panic as an opportunity. The massive cash anchor established back in Act 2 operates as a free call option with no expiration date, sitting in reserve until asset prices collapse. The signal to deploy that cash is the SIBO Volatility Index, or VIX, a real-time measure of expected market turbulence. When extreme panic pushes the VIX index above a reading of 30, it triggers a systematic shift. Capital moves out of safe government debt to acquire distressed, hyper-volatile growth equities at historically depressed valuations. You isolate preservation from speculation. By mathematically guaranteeing your survival during the worst market conditions, you ensure you always have the capital required to harvest the best of them.